Hi, morning everyone. Thank you for joining the today's session. So today we are going to discuss about if market is up, your portfolio is in what's going on. So start with a simple question like, have you ever felt like the market is doing well, but our portfolio is not growing the same way? Like, so if open the news, market are hitting the new highs, but when you check our investments, returns feel average or sometimes even disappointing. So, like if you relate to this session is exactly for you. Today we are going to break down why this gap happens, the hidden mistakes investor makes, and most importantly, how to fix it. So, the truth is the market doesn't fail investors. Our own behavior it's lead to fail. So, and this usually doesn't happen because of lack of knowledge. It happens because of wrong decisions or emotional reactions. So let's understand the each mistakes one by one. So most of us today are participating in markets, but still feel like the portfolio is not growing the way it should. Like let's say, as I said, markets are doing well, the indexes are hitting highs, but when you check our own portfolio, returns feel average or highly inconsistent. This gap usually doesn't come from the market; it comes from a few simple mistakes in how our portfolios are built and managed. The first is no clear investment goal. So money gets invested, but there is no clarity on why it is being invested, when it is needed, or what outcome we expect. So a very common situation is someone starting in SIP and after 6 to 8 months checking returns and feeling disappointed. They start questioning whether to continue or stop. The issue is not the fund or the market. The issue is that there was no time horizon defined. So another example is investing in equity and expecting returns within 1 year. Equity is meant for long-term growth. So expecting short-term results creates frustration. When goals are not clearly defined, you don't know how much to invest, you don't know where to invest, and every short-term movement starts feeling like a problem. That's why the portfolio feels uncertain even when markets are doing fine. So, and the second and most important issue is asset allocation. This is where most portfolios go wrong without we realizing it. So, investing is often seen as selecting the right fund or stock, but in reality, how your money is distributed across asset classes matters more. These are two common extremes here. The first is over concentration. Some investors put most of their money into equity or into a few funds or sectors. During a bull market, sometimes it feels great because returns are high and portfolio grows quickly. But when corrects, it's corrects around 20-25%. The entire portfolio fall at the same pace. And at that point, doubts are coming in whether to exit, whether this is too risky, whether something has gone wrong. The problem is not always the investment itself; it's the lack of balance in our portfolio. And the second extreme is over diversification. Some of us hold too many funds, 10, 12, sometimes even more. When you ask why so many, there is usually no clear reason. Many of these funds are overlap, meaning they hold a similar kind of things. As a result, returns become average, tracking becomes difficult, and decision making becomes very confusing. You are investing everywhere, but not meaningfully anywhere. A simple way to think about this is balance. Yeah, a structured portfolio typically has equity for growth, debt for stability, and sometimes maybe like a gold for diversification. This balance helps control downside during market correction and make it easier to stay invested. And another mistake is chasing past performance. This happens very frequently. Fund delivers strong returns in the previous year, become popular, and naturally attracts more investors. We start investing after seeing that performance, but by that time, a large part of the returns has already been made. After entry, our returns often normalize, but expectations remain high. That leads to the disappointment. Then again we move to another fund that has recently performed well, and the same cycle repeats. So entering after high returns and exiting after low returns is the opposite of how wealth is created. The issue is not that fund is bad, but the timing and the expectations are not aligned. When you step back and look at these three lack of clear goals, poor asset allocation, and chasing past performance, they are not complex issues. They are simple, but we repeat consistently. That is why. Even in a rising market, different portfolios deliver very different outcomes. The solution is also simple, but it requires discipline. Clear goals bring direction, proper asset allocation brings balance, and consistency in approach avoid emotional decisions. Say in investing, disciplines becomes matters more than our intelligence. So most of us believe that if our money is growing, they are doing well. We see 5 to 6% returns and feel comfortable. But here is the reality: growth in numbers doesn't always mean growth in wealth, because what really matters is not what you earn, it's always what your money can actually buy. This is where a very important concept comes in. Real return. Real return is simply your return minus inflation. Nominal return is what you see in your statement. Real return is what you actually experience in life. You might feel like your money is growing, but if your expenses are growing faster, you are actually going backwards. Take a very practical situation. You invest in a fixed deposit, it gives you around 6%. At the same time, inflation is around 7%. So effectively, you are losing around 1% every year in real terms. And the important part is you don't feel this loss immediately. There is no visible drop, but your purchasing power slowly reduces over time. Now, fixed deposits are often seen as safe, and they are in terms of volatility. There is no market fluctuation, no day-to-day stress, but safety has two sides. One is market risk, other is inflation risk. Most of us focus only on avoiding market risk, but completely ignore inflation risk. And this doesn't mean fixed deposits are bad. They absolutely have a role. They are useful for stability, emergency fund, or short-term goals. But the problem comes when the entire portfolio is built only around safety, because over a long period, inflation becomes the bigger risk. This becomes even more important when we think about future expenses, especially healthcare. Medical costs are not rising at 6 to 7%; they are rising much faster. The question is not whether your money is safe. The question is, will it be enough? Because a portfolio that feels safe today may not be sufficient tomorrow. That's why this is often called a silent wealth destroyer, not because it creates sudden losses, but because it quietly reduces your financial strength over time. It doesn't create panic like market crashes. It doesn't show visible losses, but slowly and consistently, it affects your ability to maintain your lifestyle. So the real issue is uh, not the people are investing incorrectly. It's that they are measuring success incorrectly. They look at returns but ignore purchasing power. That's why investing cannot be only about safety. It has to balance stability, growth, and inflation protection. If your investments are not going faster than inflation, your wealth is not increasing. It's slowly shrinking. So let's move to the next slide. So this is where most of us try to be smart, timing the market. It sounds logical, but at the right time, sell at the right time, avoid losses, maximize gain. But in reality, this is where most of us lose. Okay, we start with the first big event. So investing at market highs. This is usually doesn't come from analysis. It comes from FOMO. Market goes up. News is positive. Everyone around is talking about returns, and slowly you feel like I might miss out if I don't invest now. So you enter exactly when risk is highest and upside is limited. By the time something feels safe in the market, it's usually already expensive. Now comes to the opposite mistake, exiting during correction. When market falls, portfolio turns red, news around us turns negative, fear starts building, and that's when we started to exit. But here's the reality: the biggest gain since the market happened during the recovery. And recovery doesn't give you a warning, it doesn't wait for confidence, it happens fast. So when you exit in fear, you lock in losses and miss the recovery. And then comes up one of the most damaging decisions, stopping SIPs during downturns. This is actually the best time to invest when markets are cheaper. But what investors do is they stop SIP, they wait for stability, they wait for clarity. And by the time clarity comes, market is already up. So instead of buying low, they stop buying at the lowest point. So if you look at all three, buying high, selling low, stopping at the bottom, that's the exact opposite of wealth creation. Timing the market sounds smart, but discipline in the market works better. Let's make this very real with a simple example. No, the same market, same starting point, same time period, but four different investors, and the results are completely different. First investor does nothing, invests one crore, sees the crash, see the recovery, but doesn't react. In the result, around 10% return, 1.8 crores, not perfect, but still decent. Second investor stay calm during panic. When market crash, instead of stopping, they invest more, adds money during the lowest point when fear is highest. Result, highest return. He gained around 12%. This is how wealth is actually created. And if you look at the third investor, wait for safety. Doesn't invest during crash, wait for market to recover, then invest at highest level. Result around 10%, and better than doing nothing but miss the real opportunity. Now, the most common investor, panic seller. During crash, they sell, invest, moves the money out of market, later re-enter at the highest level. So in the end result is he got lowest return, just 7%. The same market, but behavior destroyed return. So what's changed here? Not the market, just behavior. Your returns are not decided by the market, they are decided by your actions inside the market. So up to this point, we have spoken about mistakes, but if you look closely, most of these mistakes don't come from lack of knowledge. They come from our behavior. Because in investing, the biggest risk is not the market. It's how we react to the market. If we simplify investor behavior, almost everything comes down to three things, fear, greed, and noise. Let's look at how each one quietly destroys our returns. Let's start with fear. This usually shows up when market fall. When your portfolio is number, you see negative news or around a negative uncertainty increases, and even if nothing has changed fundamentally, it feels like something is wrong. That's when investors start selling. But what are they actually doing? They are converting temporary losses into permanent loss because markets do recover. But the problem is many of us not there when recovery happens. Fears doesn't just make you exit, if makes you exit at the wrong possible time. Now let's look at the other side, greed. This doesn't feel negative. In fact, it feels like a smart decision. You see a fund performing well, you see high returns, and naturally you feel this is where I should invest more. But by the time something becomes a top performer, most of the growth is already captured. So what happens is you enter at high levels, returns slow down, and the disappointment starts. And then you move to the next top performer. This cycle keeps repeating because greed focuses only on past returns, not the future potential. So, and the next one is noise. This is not about fear or greed, it's about confusion. Every day there is information, some headlines, market prediction, tips from your friends, and social media opinions. And without a clear strategy, every piece of information looks important. So, investors keep reacting to every noise. One day they buy, another day they sell, then they switch funds. There is activity. There is always be some activity, but no direction for that. So noise doesn't destroy your portfolio in one big move. It slowly destroy over time. So if you look at all three, fear makes you sell low, greed makes you buy high, noise keeps you in custody, and together it will create underperformance in your portfolio. And these are the most important thing. These are not a market problem. These are generally human behavior problems. Unless behavior is managed, even the best investment won't give you the best results. So and another thing is buy and hold is one of the most popular ideas in investing, and it's often misunderstood because many of us interpret it as buy something and never sell it. But that's not what really means. The real idea is much more practical. It's not about holding forever. It's about holding the right investments for the right reason, and that decision makes all the difference. Let's start with the first principle. Review your portfolio regularly, not daily, not emotionally, but at least once a year. Because over time, markets change, business change, your goals also change. If you don't review, your portfolio slowly becomes outdated. Doing nothing is not always discipline. Sometimes it's neglect. And second one is exit when the fundamental story changes. This is where many investors struggle. Investing is not about being right all the time. It's about adapting when things change. For example, a company's growth slow down, a sector loses momentum, a fund manager strategy changes. If the original reason you invested is no longer valid, holding it doesn't make sense anymore. This brings us to a very common behavior, holding underperformance and hoping they will recover. Everyone has that one investment that they don't want to sell, because selling means accepting the loss. So instead, we wait and wait. But hope is not a strategy. Time does not fix bad investment, it only delays the decision. Uh, because patience is still required in investing, but patience is often misunderstood. Patience doesn't mean holding everything forever. It means staying invested in the right things. So strong businesses, good funds, consistent performers, these deserve time. But weak investments don't become strong just because you waited. So here the key takeaway for us is review regularly, be willing to exit, avoid emotional attachment, stay investing in quality products. So here there is a lot of discussion today around active versus passive investing, and often it's presented like a debate which one is better. But in reality, this is not about right or wrong. It's about what works for you, because both approaches are valid, but they serve different purposes. Active investing is where a fund manager is making decision for you. They choose which stocks to buy, which sectors to avoid, when to enter or exit. So what's the advantage here? First, downside protection. In difficult markets, a good fund manager can reduce exposure, avoid risky sectors, and protect your portfolio to some extent. And the second, flexibility. They are not bound to follow an index. So if something looks overvalued, they can move away from it. Third, expertise. You have a professional making decisions based on research, experience, and market understanding. But this comes with a trade-off, higher cost, like say expenses are slightly higher, and performance depends on the fund manager. So not all active funds outperform. So selection is matter. Now let's look at passive investing. This is much simpler. You are not trying to beat the market, you are becoming the market. So here first, low cost. So since there is no active decision making, expense ratio are very low. Second, no manager dependency. You are not relying on someone call, you are just tracking the index. Third, simplicity. It's straightforward and very easy to understand. But there are limitations. There is no downside protection. If the market falls, your portfolio falls with it, and you are always fully invested. So if markets are expensive, you are still investing at those levels. So if you look at both, active investing tries to manage the journey. Passive investing focuses on staying on the journey. One gives flexibility and protection. The other gives simplicity. So the real question is not active or passive, it's what combination works best for your goal, risk level, and behavior. This isn't about picking one over the other. It's about what actually works for your portfolio over time. So far, we have looked at a lot of things where portfolios goes wrong, how behavior impact returns, why timing, emotions, and wrong decisions at performance. And if you step back and look at it, the gap between market returns and your return, it is not random. It comes from a few repeated patterns. So these mistakes are completely avoidable, and fixing them doesn't require anything complex. It comes down to simple, consistent actions. First, clarity in what you are investing for. Instead of I will continue. So first thing is clarity in what we are investing for. So instead of random ideas like I want good returns, it helps to be specific how much money is needed, what it is for, and when it is required. Because in real life, different goals need different approaches. For example, money needed in 1 to 2 years cannot be invested the same way as money meant for 10 to 15 years. And once this clarity is here, everything else become easier. How much risk to take, where to invest, how long to stay invested. Without this clarity, every market movement creates doubt. So second, staying invested consistently matter more than trying to time things. We have already seen how timing plays out in reality. Entering after markets have already gone up, exceeding when market corrects, stopping SIPs when things feels uncertain. These are very natural reaction, but they usually work against our long-term return because markets don't reward perfect timing, they reward consistency. In simple terms, being in the market matters more than trying to predict it. Third, managing behavior is just as important as selecting investments. Fear, greed, noise, they don't go away. You will still feel uncomfortable when market fall. you will still feel tempted when something is performing well. But what helps is having a system in place, asset allocation, SIP discipline, long-term perspective. These acts like your guardrail. So decisions are not taken emotionally because most mistakes don't happen due to lack of knowledge. These they happen in moment of reaction. And finally, regular review and rebalancing. Over time, some part of portfolio will grow faster, some will lag behind. So even if you started with a balanced portfolio, it slowly become unbalanced. For example, if equity performs very well for a few years, it starts dominating the portfolio. Third, that increases the risk even without you realizing it. And that's where rebalancing in. It brings the portfolio back to its original structure. It's not about frequent changes, it's about keeping things aligned. So if you simplify everything we discussed today, wealth creation is not about finding the perfect fund, predicting the perfect time, or avoiding every mistake. It's about following a process that we have to stick. So because over time, consistency beats complexity. So everything we discussed so far, mistakes investors make, behavioral challenges, importance of discipline, all this sounds discipline, but in practice, it's not easy to follow consistently. And that's exactly where structured guidance makes a difference. Our role is not to predict market, it's to help you build portfolio that works consistently across different market conditions. First, structured portfolio design. This is where everything starts. We don't begin with product, we begin with your goals. What are you investing for? What is your time horizon? What level of risk is comfortable for you? Based on that, we create a clear asset allocation strategy. So your portfolio is not random, it is aligned to your purpose. Second, behavior and decision support. This is one of the most underrated aspects because during market movements, even good investors struggle with decision. Should I invest now? Should I exit? Should I wait? And this is where guidance matter. And fund selection and simplification. Most portfolios today are overcomplicated. Too many funds, overlapping strategy, no clarity on why each investment exists. Our focus is simple. Select the right funds, keep it clean and manageable. Ensure every investment has a purpose. And finally, review and rebalance because your portfolio is not something you built once and forget. As market moves, allocation change, risk change. So we regularly review and rebalance to keep your portfolio aligned with your goals. So overall, it's not about chasing the best returns. It's about building a system that works over time. So everything we discussed today, mistakes, behavior, discipline, all of it's come down to one thing, how you approach investing. And this is the framework we follow. It's based on four simple principles. One, consistent outcome. Will that's compound over time. First, long-term focus. We don't measure success in months or quarter. We measure it over years because short-term volatility is not risk. Real risk is permanent loss of capital. So instead of reacting to every movement, the focus is on staying aligned with long-term outcomes. Second, non-conscious investing. This means not simply following what everyone else is doing because when something becomes popular, a lot of the returns are already captured. So instead of chasing trend, the focus is on identifying opportunities yearly with conviction. So, but conditions create outperformance. Third, bottom-up investment selection. This means every investment starts with understanding the business. What does it do? How does it grow? Why does it deserve capital? Not just macro views, not just macro trends, but clarity on what we own. When you understand what you own, you don't react to every market movement. And finally, risk management. This is not optional. It is important to everything. So it's protect the downside risk because if losses are controlled, growth take care of itself. Good investing is not about avoiding volatility, it's about avoiding permanent damage. So next, it's our investment and product services are designed around one simple idea. Different investors need different solutions. Some investors are just starting their journey. Some are looking for long-term wealth creation, and some want a more actively managed approach. So instead of a one-size-fits-all structure, we offer different investment solutions based on investment needs, risk profile, and portfolio size. One of this is our portfolio managed services. This is designed for investors looking for a focused, professionally managed and portfolio experience. So instead of tracking market daily or constantly figure out when to enter or exit, that portfolio is managed through a defined investment framework. Because in reality, the different difficult part is usually not starting an investment journey. It's staying consistent through different market conditions. When markets are rising, emotions change. When market correct, behavior change. And when uncertainty increases, decision making becomes becomes difficult. So a structured approach helps navigate all of this with discipline and consistency. We have been operating since 2019 with 3,200 crore plus AUM, 1,800 plus clients, multiple investment strategies, all built around a disciplined investment process. So we offer different strategies based on different investor requirements. Flexi cap for balance exposure, large cap for stability and consistency, small cap for long-term growth potential, multi-asset for diversification across asset classes. The idea is not just participation in markets, it's managing portfolio through different market cycles. It means managing risk, adjusting exposure where required, and capturing opportunity in a structured manner. And ultimately, what this gives investors is clarity, consistency, and confidence to stay invested over long term. So now, not every investor start with large capital. That's where this platform comes in. Milestones to wealth. It is designed for investors who are starting their journey, are building towards their first flow. It is a goal-based, milestone-driven approach. Instead of random investing, you move step by 2 lakhs, 5 lakhs, 10 lakhs, and 25 lakhs, and 1 crore and beyond. So investing becomes structural and progress becomes visible. Today we have 1,200 plus crore AUM, 7,500 plus active clients, which shows that this approach is working for many investors. The focus here is simplicity, discipline, goal-based investing. It's ideal for investors who want to start small, stay consistent, and build well step by step. So that's all from my side today. Thank you for attending patiently. Thanks for joining and attending the session. We will meet in the next webinar. So thank you everyone for the participation.